We're going to talk about health insurance today. Health insurance. One of the reasons why healthcare in the United States is so expensive. A single doctor's office visit may cost several $100s, and an average 3-day hospital stay can easily be as expensive as tens of thousands of dollars or even more. Just ask me. In the United States, there are different ways you can be insured. You can be sponsored by the government, sponsored by your employer, or you can directly pay for your insurance. Medicaid is one way the government helps provide health insurance. This is a health insurance program based on income. It is based on a certain income level. The other way government provides insurance is through the Medicare program. This is available for people age 65 or older, younger people with disabilities, and people with permanent kidney failure requiring dialysis or transplant. Employer-sponsored and individual insurance programs are paid in part by the employer as a benefit or by the individual. The benefits vary depending on the cost of the insurance. But when you're paying for insurance, or your employer does, how does paid insurance work? Well, the way it typically works is that you pay an upfront premium to a health insurance company, and that payment allows for you to share risk with lots of other people, those are members, who are making similar payments. Since most people are healthy most of the time, the dollars paid to the insurance company can be used to cover the expenses of the relatively small number of members who get sick or are injured. One way that healthcare insurance plans control costs is by influencing access to providers. And by providers, I mean physicians, hospitals, laboratories, pharmacies, and others like therapists. Many insurance companies contract with a specific network of providers that have agreed to supply services to plan members at a more favorable pricing. Therefore, if a doctor is not in a plan's network, the insurance company may not pay for the service provided or may pay a smaller portion that it would pay if that provider will be inside the network. This means that if you go outside of that network, you may be required to pay a much higher share of the cost. The Affordable Care Act, or the Obamacare, is a comprehensive law enacted in 2010 that increases health insurance coverage for the uninsured. One of the things that this law has done is to introduce a standard of benefits. I know it's not perfect, but before that, the benefits could be very different between plans. Now, plans in the United States are required to offer a number of what it's called essential benefits. So, how much will it cost to have insurance? Well, understanding insurance cost is quite complicated. Costs start with a premium, which is an upfront cost paid to enroll in an insurance plan. Unfortunately, this is not the only cost associated with the care you receive, as there are also added costs when you access care. Those are known amongst others as deductibles, coinsurance, copays. These represent the share you pay out of your own pocket when you receive care. As a general rule of thumb, the more you pay in premium upfront, the less you will pay when you access care. The less you pay in premium, the more you will pay when you access care. It's just a balancing act. That's why it is very important that you are familiar and understand these insurance terms and concepts. Let's talk about them. Out-of-pocket expenses. They refer to the portion of your medical expenses you are responsible for paying when you receive health care. The monthly premium you pay for care is separate from these costs. An annual deductible. The annual deductible is the amount you pay each plan year before the insurance company starts paying its share of the cost. If the deductible is $2,000, then you would be responsible for paying the first $2,000 in health care you receive each year. After that, then the insurance company would start paying its share. Copayment. The copayment or copay is a fixed upfront amount you pay each time you receive care when that care happens. For example, a copay of $30 may be applicable for a doctor's visit, after which the insurance company picks up the rest. Plans with higher premiums generally have low copays and vice versa. Then, coinsurance. Coinsurance is a percentage of the cost of your medical care. For example, for an MRI that costs $1,000, you may pay 20%, that is $200. Your insurance company will pay the other 80%, that is the $800. As you can imagine, plans with higher premiums typically have less coinsurance. Annual out-of-pocket maximum. The annual out-of-pocket maximum is the most cost sharing you will be responsible for in a year. It is the total of your deductible, co-pays, coinsurance, but it doesn't include your premiums. Once you hit this limit, the insurance company will pick up 100% of your cover costs for the remainder of the plan year. Plans with higher premiums generally have lower out-of-pocket limits. Cover benefit. The terms cover benefit and covered are used very regularly in the insurance industry, but can be a little bit confusing. A cover benefit generally refers to a health service that is included under the premium for a given health insurance policy that is paid by or on behalf of the member patient, that is your employer or yourself. So, cover means that some portion of the cost for a service will be considered for payment by the insurance company. Considered. It does not mean that the service will be paid at 100%. So you need to have that clear. So, it is important to understand how insurance works and what all these terms mean. That's why I want you to remember these 5 very important things about health insurance in the United States. Healthcare is expensive in the United States. Health insurance can help manage those costs. Coverage can be done by the government, through an employer, or by the individual. The lower your premium, the higher the share of costs later. And insurance costs are not limited to the premium only. Just remember that.